Hello, everybody, and welcome to the Public Podcast. I'm your host, Kinsey Grant. We are here with you today to discuss Amazon and what analyst Mark Mahaney is calling his triple trough thesis on the stock. But before we get to explaining what all of that means, don't forget to like, comment, and subscribe to our YouTube channel for more in-depth interviews that will help keep your portfolio on track. Today, I'm so excited to welcome our guest, Mark Mahaney, who's a Senior Managing Director at Evercore ISI Research Division. He's going to come on and discuss Amazon, tell us about this thesis that he has about Amazon, and tell us a little bit more about the stock, both what's been going on and what we can expect in the back half of 2023. Also want to note, Mark is the author of Nothing But Net, 10 Timeless Stock Picking Lessons from one of Wall Street's top tech analysts. And we're actually doing book giveaways. So if you want to get your hands on a copy, just send a DM to the Public Live handle. So without further ado, Mark, welcome to Public. How are you today?
Good. Thanks for having me on, Kinsey.
Of course. I'm excited to chat today. So we're going to be digging into a recent report that you put out in which you broke down this triple trough thesis, say that 20 times fast, right, on Amazon, which you believe is being underappreciated by the market. So Mark, to kick us off here, could you explain what this triple trough thesis is and why it makes you more bullish on Amazon?
We think that Amazon's multiple is at very close to trough levels. We think Amazon's margins, operating margins, are probably close to trough levels and will expand as we go through the year and into 24. And we think there's a distinct possibility that Amazon's revenue growth, both on the retail side and on the cloud computing side, their AWS segment, Amazon Web Services segment, we think that growth has a distinct possibility of accelerating as we go through the back half of the year and into next year. That's the triple trough thesis: trough multiple, trough margins, trough revenue growth.
All right, so multiple margin.
Why it matters, by the way, Kinsey, is like you want to buy stocks when they're not at peak multiple, peak margins, and at peak revenue growth. It's that move off the bottom, if you will, stock price wise, fundamentals wise, that oftentimes can work really well for stocks. I've been covering tech stocks for 25 years and made plenty of errors along the way. But, I like to find these inflection points. Or the concept that was in my book is in my book, DHQ, Dislocated High Quality Companies. I think Amazon's one of the most highest quality names out there across the investment landscape. And it's clearly dislocated. The stock has been a dog for the last 2 to 3 years. Like, that's not a good thing. It's been roughly flattish. It's underperformed the market. It started to do well this year, but that's after material outperformance for about 18, almost 24 months. And so this is a chance, I think, a fresh new way to come at the stock and to come into the name. And we think there's a lot of upside here.
Yeah, it certainly makes a lot of sense, explaining the triple aspect of this triple trough. And Mark, before we get into that nature of underperformance for Amazon over the last 18 to 24 months, I wanted to ask before that, this idea that there are peaks and troughs for any, metric that we're talking about for a stock. What is typically the cycle of something like that? Is there any way to, estimate the length that you go from trough back to peak, back to trough again? Is this a long time we're talking about? Is this a shorter time?
Boy, I wish no, there isn't. It depends on the company. It depends on a million things. Let me try to put some numbers around this so it doesn't seem like I'm completely making this up. Prior to COVID, Amazon traded at very regularly, very consistently at around 20 times EBITDA. Whether that's the right valuation metric or not, I don't know, but I'd probably argue it isn't. But that's what it consistently did. That's what the market put on Amazon stock. And Amazon was a dramatic outperformer for a long period of time, till about halfway through 2020, 3/4 of the way through 2020. And then it really had this 2-year kind of drag, traded sort of sideways, underperformed the market. And so what happened to the multiple? It went from 20 times, that was its average multiple, and its peak multiple, it actually rarely get up to like 24 times. Its trough multiple, the lowest multiple it had, was kind of 10, 11 times. It's currently sitting at around 12 times. So it's not an absolute trough, no. But it is closer to the trough than it is to the peak. And why did the multiple go down? We need to answer that question. Well, I'll tell you why. If you told me 3 years ago that AWS, the cloud computing part of Amazon, was going to be growing 11% year over year, that's what they said it grew in the month of April on their last earnings call. for a company that very consistently did 30% plus AWS growth, revenue growth, I would have said, wow, the world must be really falling apart. If you had told me that a company that for consistently for 10 years had generated positive free cash flow year in, year out, 10 years straight, at least 10 years straight, was going to do 2 years in a row of negative free cash flow, I would have said, wow, the world is falling apart. And if you had told me that the retail business, retail part of Amazon, which was consistently not highly profitable, but they were doing 2, 3 to 5% operating margins. I mean, this is mass market retail. Those are the kind of margins you get. But if you had told me that that business was actually going to go negative and have its first negative operating margins in about a decade, I would have said, wow, the world is falling apart. Well, that's what happened. Those three things happened. That's why the stock derated for good reasons. I wish I saw that 3 years ago, but I'm great at this explaining the history. The question is whether I can predict the future. Yes, just as well as anybody else can, just not that well. But anyway, that's the setup. That's why the stock um, uh, derated. That's why the multiple came down. And if I'm right, if we're right that margins can start recovering, if we're right that revenue growth can reaccelerate, the multiple usually follows. Multiples are high because the growth is high. They're low because the growth is low, and they rise when the growth reaccelerates, both top line and bottom line. And I think that's what's going to happen. So we can go through the reasons why I think margins will recover and why I think revenue growth will reaccelerate. If we're right on that, I think that's the path to the reacceleration in the multiple, the re-rating in the multiple.
Yeah, so let's dig into that. To your point, this idea that we hit this point in the trough because, for lack of a better word, the world did fall apart, right? All sorts of crazy, extenuating circumstances have hit many stocks, all stocks, right? But especially Amazon here. What gets us out of that trough? What are the factors that contribute to getting back to those multiples and margins you were talking about before?
Okay, so let's just focus on the margins first. So yeah, again, Amazon was doing like 5% operating margins for its retail business. Last year went negative. Now, last year was this inflation was, we had generationally high inflation last year. And you saw it in a lot of basic things, but things that maybe aren't so clear. So you had huge spike in fuel costs in the first half last year, huge spike in shipping costs in the first half of last year. You had a material increase in labor costs, and you had a material increase, by the way, in a lot of basic materials like steel. Well, guess what? Amazon's macro squared. So they're major buyer of fuel costs because they run all those vans all over the place. Major buyer of shipping. I mean, like container shipment costs. That's what I mean. They take products from the world's factories, a lot of which are in China, and they come here, and shipping costs were jacked up in part because of the COVID shipping shutdowns in China. And then a lot of this was macro out of their own hands. The Ukraine, the further invasion of the Ukraine caused fuel costs to spike up. And then there were other things. It wasn't just macro. Like Amazon acknowledged it too. They overbuilt. They over-extrapolated from the COVID crisis. So they overbuilt this distribution capacity. So they had all these fixed costs. So it was like a perfect storm. I could come up with 3 or 4 factors. I just mentioned 3 that put this enormous pressure on Amazon's margins last year. Anyway, so they had to dig their way out of that. Now, in part, you have seen fuel costs come down after that unusual spike last year. In part, you've seen shipping costs come down after that unusual spike last year. And then Amazon has slowed down its capacity expansion and has started to see, they've started to grow their retail revenue. So capacity utilization has risen, which helps margins recover. So that's why I think you're going to continue to see more of that. They also did painful but necessary RIFs, reduction in forces, so that helps with the margins on the retail side too. And on the AWS side, this was a company that had 30% operating margins. They went down to 25% margins, which most companies would kill for. Those are great margins, but not by cloud computing standards. But if the revenue growth reaccelerates, those margins will recover. And then real quickly on the retail side, there are 2 things I think can cause revenue growth rates to reaccelerate. I think consumer discretionary spend is weak this year, just flat out. I think that statement is true. And Amazon retail is not as much as it used to be, but it's still heavily skewed. Like 70% of their sales will probably fall into consumer discretionary spend. Think apparel, think media, entertainment, purchases, whether it's video or books or what have you. It's a lot more consumer staple than that, but still, there's a heavy amount of consumer discretionary spend, and that's soft in this environment. We think that'll recover next year. There's another idea that I really like, Kinsey, which is what I call this concept of shipping elasticity. And Amazon started talking about increasing prime delivery speeds. I noticed that in my suburban area of California, outside of San Francisco. It's only since the last couple of months where Amazon, if I order something at night, I'll get it the next morning before 7 a.m. I order it in the morning, I'll get it in the afternoon. I order it in the afternoon, I can even get it at night. And what Amazon has done is created all this distribution capacity in order to do faster and faster delivery. And my guess is that it's not just the Mahaney household. There are other households out there that when they get faster shipment from Amazon, Amazon is giving them one less reason to drive to the store, one more reason to buy with Amazon. And so I think that, this shipping elasticity idea that we came up with, like demand elasticity, price is lower, demand goes up. Shipping elasticity, the faster you ship, the more people will buy from you. So I think that's going to also cause this acceleration. And then flip it real quickly to AWS, why that growth is going to reaccelerate. You are a year into the softening of enterprise spend for cloud. So that's called anniversarying the slowdown. So that means it increases the odds of a reacceleration. I also have a quick thesis that AI is such a big theme. I think there's going to be more and more AI workloads. You're going to find more companies trying to literally more directly put AI into their products. AI DJ on Spotify, a travel bot on your Expedia travel search engine. And you know what AI is? AI requires more compute power, more storage capability. The crude way I say it is the AI revolution is not going to be televised. It's not going to be on-prem. It's going to be in the cloud. That means there's going to be an acceleration in demand for industry cloud services and solutions. And you know who the largest cloud vendor is? It's not Azure. It's not Microsoft. It's AWS. Now, Azure has been using this through a really strategically savvy investment in OpenAI to kind of take market share gains. And I think AWS got a little bit caught flat-footed. I just think that they're going to be able to recover, and they'll be able to participate along with Google and Azure in this kind of accelerating cloud spend driven by this generative AI cycle. So that's another reason why I think AWS growth will reaccelerate going into next year.
Yeah, it's a lot of factors to consider, and I appreciate all of the the full view of what's going on at Amazon. Now, I know when we first started talking today, I asked you a question about timing. You've mentioned also that nobody can predict the future, but knowing what you know, I'm curious to hear a little bit more about the general timing of how you expect this momentum to really pick up in terms of pacing. So we can either kind of talk about the bigger picture, how far out are we from Amazon getting back to that point, closer to the peak as opposed to the trough, but also just more specifically, what are your expectations for this stock in the back half of 2023, knowing that we're coming in on H2 here? What are you expecting? What are you thinking?
So Kenzie, this is now one of our top 3 picks. When I came up with the thesis a month ago, so it was kind of one of the reasons we made it the top pick in the space. So Meta's our number 1 pick, Uber's our number 2 pick, Amazon now has become our number 3 pick. First time it's been a top 3 pick for us in well over a year. I'm not exactly sure when, but something like well over a year. And so I'll make 2 other points. One is that don't forget the market is a discounting mechanism. So it's not like the market's going to the stock will go up if more people believe, like I do in the triple trough thesis, the more people are going to buy the stock in anticipation of the upturn. And then if the upturn doesn't come through, then the stock will come back down. But the stocks usually anticipate, or I call it the hope trade. They hope that things will happen, and so so the stock will go up 3 to 6 months before it's clear in the fundamentals. And then I do think that you're going to start seeing this reacceleration for AWS. That's probably the single most important factor here. I do think you're going to start seeing that in the back half of this year. So that's Q3 or Q4. Whether it's going to be strong enough, I don't know where exactly expectations are set. I'm just, there's the expectations game and there's the fundamentals reality. And I think if AWS growth reaccelerates from 9, 10, 11% in the June quarter and people gain confidence that it's going to continue to accelerate next year, that's probably going to be enough for the stock. Where the stock is right now, Kinsey, I forget now, we're like 120, I think, 125 on Amazon shares today. That's good enough. Now the stock starts moving up and it gets above 150, 160, 170. Okay, we'll have to get the market will be getting tighter on how fast that acceleration is going to be. But for now, just the reality of that acceleration and then the ongoing recovery in the operating margins, I think that takes the shares higher. And I think you'll start seeing that multiple go from 12 times EBITDA to 13 to 14. And, you're still well off of the 20, roughly 20 average forward multiple that it's had. And it doesn't mean that stocks go back to their historical average multiple. Stocks go back to their historical average multiple if their fundamentals go back to their historic average, fundamentals, which is the revenue growth and the margins. And if they go better than that, the stock will re-rate higher. And if they don't go as high, but it's just, to me, there's just so much room for the multiple to go up before you get back to the average that's what makes the stock so interesting here to me. The risk reward, I think, is highly asymmetric to the upside.
Yeah, I appreciate this, Mark. I think that, to your point about the hope trade, a lot of investors, I'm sure, we have these ideas of what a company could do, what a company might do. But it's interesting to reconcile that idea of hope or that idea of anticipation with the fundamentals, and to understand when those 2 points converge, I think is a really useful tool for investors like myself and like plenty of people who are listening to this. So, Mark, thank you so much for joining me today. This has been so wonderful. I really appreciate you sharing in so much detail your thesis on Amazon and on the triple trough. It's been very interesting to understand. So thank you so much for coming by.
Thank you, Kinsey. Nice to see you. Have a super weekend.
You too. That was Mark Mahaney, Senior Managing Director at Evercore ISI in the Research Division. I'm Kinsey Grant. This is the Public Podcast, and thank you so much for listening. See you next time.